So have you found yourself when you're explaining Bitcoin to people, whether it's a potential new customer, or family, or friend, that the way you are explaining it has changed? Because I have, like, I find, especially right now, it becomes a lot easier to explain why Bitcoin has value by explaining what is going wrong in the current system. Especially, I mean, you can't help but miss what's going on in the UK at the moment. We've got high inflation, rising interest rates. We nearly had the pensions collapse. The government suddenly found 60 billion when they can't even pay for some social services. They found 60 billion to rescue the pension funds. We've got a massively growing debt to GDP ratio. We've got both a government and a currency that's, I think, is in crisis. That becomes a lot easier to explain. When somebody turns around to me and says, why should I care about Bitcoin? Explain Bitcoin to me. And actually, I just start explaining what the problems are with the current system. Whereas I used to explain what Bitcoin is. I used to say censorship-resistant monies. But now I just explain the problems with the current system. Is that something you're finding you're doing?
So the way that I came to understand Bitcoin in 2016 really revolved around this whole thing. Like I figured out that, at that point in time, the Fed was in the process of at least starting to signal to the market about how they were going to unwind post-financial crisis quantitative easing. And I realized that that would never be possible, that they would never be able to get out. They would never be able to unwind. And even if they pursued a path over 2017 to 2019 to take some portion of that money that they had put in from 2009 to 2014, they would never be able to sustain that, and they would have to put in far more money. So
is that, sorry, just to interrupt, is that because you can't close the gap between dollar-denominated debt and dollars available that have been issued? You cannot close that.
The only way to close that is by printing money. I mean, functionally, there are technically two ways. You could either let the debt collapse, or you could, really there's two frameworks.
Yeah.
You have a debt problem. 2008-9, we had, I think most people, even at this point who didn't understand what happened at the time, recognized that we had a unsustainable, an unstable and unsustainable debt problem. In that scenario, you can either allow debt to be restructured, to basically be written off, or you can print more money to be able to repay those obligations. So like the way I think about it is like with an individual company, when it can't pay its obligations, it restructures. Potentially it restructures and continues forward, or it goes away.
Same with a mortgage. You can restructure your mortgage.
Yeah. But you're basically writing debt down. Same with an industry. Maybe there's a secular shift and we move away from an industry. Those companies either restructure or they go away. But when it comes to the system as a whole, the debt levels create this scenario where, functionally speaking, over the course of many decades, the Fed responded by, rather than taking a debt problem and allowing a system to be restructured and to allow debt system-wide to be written down and written off, they allowed an unstable debt problem to persist and to be exacerbated by introducing more dollars to allow credit to actually expand.
Right. So for every new debt, there's a future demand for dollars. And so to meet that future demand, they have to print.
Correct.
Yeah.
Because they basically got themselves into this quagmire of every time this predicament happened over the course of the 70s, 80s, 90s on par into the 2000s, when that business cycle would contract, they would introduce more money to basically manage the quote business cycle.
But if they allowed the contraction, it's that Ray Dalio video that we keep talking about, where he talks about the economic cycles, that you have the periods, you have the credit booms, and then you have the you have the contractions. If they'd allowed that, then that would have been fine. We just would have gone through those periods. But they've eliminated the booms and busts, like in the UK.
They basically suppressed volatility.
Yeah,
and then the ultimate outcome of that was to defer, not just defer volatility, but to exacerbate it.
How does that? It's like the widening in wealth gap. How does that widening gap between credit and actual dollars happen? Is it because of things like is it the bond market? Is it pensions?
Well, like it's just easy to talk in like real terms. Yeah. So, kind of snapshot 2008, 2009. There was 52 trillion ish of dollar denominated debt, and about $350 billion in the banking system, about $1 trillion system wide. From 2009 to 2014, the Fed introduced 3.6 trillion new dollars. So depending on whether you look at it as cash in the banking system, they increased the cash in the banking system by 10x, or as a system in the whole, they increased the cash total by about 3.5 times. What those dollars did was allow those existing debt obligations to be sustained functionally, to stop the bank run, to allow more dollars to service the existing debt burden. But what it also did was introduce new dollars to allow for credit expansion.
Yeah.
So by introducing 3.6 trillion of new dollars of base money over the period from 2009 to 2017, the amount of dollar-denominated debt expanded by 30 trillion, approximately, from like 52 trillion to 82 trillion, approximately 80. So new dollars being introduced in the order of magnitude of 3.6 trillion to new debt being produced of 30 trillion, that each dollar that is introduced, say I lend you money for 30 years to go buy a house. Well, now somebody has new deposits in the banking system. They might invest those in loans. They might issue another loan. So it basically compounds. And then it all comes to, everyone, when they figure out that the system is unsustainable, then the reverse course of action takes place and there's knock-on effects. So for each dollar that is introduced in the system, many multiples of debt can be produced because of how it's recycled in the system.
Right. Okay. So I do then therefore think one of the biggest jobs we have is educating people about the current system.
Right. Well, that's one of the things. Bitcoin's hard to understand. Money's hard to understand. But the legacy system is hard to understand, right?
Yeah.
Trying to help them understand this. The way that and coming back to your question of how maybe explaining Bitcoin to people has changed, I've always gone down that consistent thread of like, the Fed has to print money, helping them understand why, helping them understand these debt to dollar dynamics, because what is really important to people is simply that fact of you've experienced historically the fact that your government has printed money, whether it's government, central bank, even though they're independent from each other, they're functionally the same. They're tied at the hip, inseparable. Empirically that they have a track record of doing that. You might not understand why they do it, but you know that they do it. And then if I can help people understand this is why it is inevitable that they have to do it again, that there is actually a mechanism that forces their hand, that connects dots for them. And then when they understand that this thing, Bitcoin, is not blockchain tech, it's not, the next tech wave, it's the solution to that problem, that makes it fundamentally easier for them to understand. What I have found in the last 6 to 9 months is, and I've had to, change some of how I've explained this, is Bitcoin. I like to think about Bitcoin as it's not an inflation hedge.
Yeah, I was about to say it's a hedge against collapse.
Well, I look at it as it's not a hedge against inflation. It is actually the solution to inflation.
Okay.
It's taking the fly out of the ointment. Inflation is a function of people printing money.
Yeah.
Central banks, 12 people sitting around a table in New York or DC or wherever they meet, in the equivalent in the UK or Tokyo. And Bitcoin fixes that. You can't print money. If you can't print money, we will not see monetary inflation. Monetary inflation is a function of that. Now, what is difficult for people to understand is, hey, at the same time when CPI inflation in the United States is 8 to 10%, and real inflation, which everyone experiences at the grocery store or the gas station, is higher than that, they think of, and they've been told a story that Bitcoin is an inflation hedge, or that simply if I go tell somebody, hey, government printed $3 trillion between March of 2020 and May of 2020, Bitcoin is the solution to that. That makes sense. But then what doesn't make sense is, hey, like, why, when there's more inflation, is the price of Bitcoin not going up? So what I've had to do is help people understand how those two things are entirely consistent with each other. And
because we've collectively, and I say collectively, not saying we're all at fault, but collectively that was a narrative that we took through Bitcoin. We said it's an inflation hedge, giving people the anticipation that when we see high inflation, that more people will be buying Bitcoin to hedge against it, which just hasn't happened. But I see what you're saying now. It's the solution, but it's a work in progress.
Yeah, and
requires more adoption.
I look, calling Bitcoin a hedge to inflation, I think it's an attempt to meet people maybe where they are because they've thought about other things as hedges to inflation without questioning the fundamental cause of inflation and what the potential solution to that would be. So I kind of view like the description of it's a hedge to inflation as always having been kind of somewhat lazy, or if it wasn't lazy, it also wasn't accurate. Because it's really competing at that monetary level. Bitcoin will replace the dollar, it will replace the euro, it will replace the yen. And that will fundamentally fix this problem that we all persist in, which is monetary inflation, or the function of central banks printing trillions of dollars. But what I try to help people understand on that point is that Bitcoin, because the explanation for that, when people say, hey, Bitcoin is, even if you say, let's forget that we said that it was a hedge to inflation. If Bitcoin is the solution to governments printing money, why in this environment where the symptoms of what all these Bitcoiners have been talking about are playing out, why is Bitcoin not going up in that turn, in that period of time? I simplify it for people these two ways. One is to recognize that while significant and material to the world, Bitcoin today, and even though it's working to replace the dollar at least is still my unit of account, and is most people's in the United States, maybe most people in the world, at least in terms of financial markets, that the entire Bitcoin universe is, the purchasing power is about between $350 billion and $400 billion. The global financial system, the value of global financial assets is $400 trillion. The dollar is the 800-pound gorilla in the room, such that when the Fed is taking measures to tighten financial conditions, dollar financial conditions and dollar financing conditions, everything else gets dragged along, as we're seeing. The euro, the pound, the yen, the stock market, the S&P, the Dow, the NASDAQ, everything becomes correlated to the dollar because the dollar is the funding currency of the world, and everyone is short dollars. Everyone is scrambling to source those dollars. So while Bitcoin is the solution to the problem of the Fed inevitably have to print more dollars to prop up the credit system, when you think about that relative size, when the global financial market, the market for financial assets goes down by 1%, $4 trillion of paper wealth gets eliminated. Bitcoin as a total is $350 billion to $400 billion. When that market goes down by 5%, that's 20 trillion of wealth being evaporated. So despite the fact that the dollar will continue to be printed over time, what's happening right now is actually the dollar supply is becoming restricted. So that's one half of it, that Bitcoin can be the solution to dollar inflation at the same time that the dollar economy and what the Fed is doing by tightening conditions is creating a run on dollars, and all liquid assets get sold when dollar financial conditions get tighter. Second piece of this is Bitcoin is adopted as a function of knowledge distribution. Bitcoin can't be, quote, a safe haven, or it can't be something that people rush to unless people understand why it exists. And if we accept the fact that, yes, in certain periods of time, like when the Fed rips the Band-Aid off and prints $3 trillion over 3 months, that episode teaches people about Bitcoin. But that also is only very topical. Figuring out why Bitcoin has fundamental value, picking up a book, reading it, listening to hours of your podcast, that is how people accessing Bitcoin, setting up a wallet, sending a Bitcoin transaction, understanding the mechanisms that enforce Bitcoin's 21 million fixed supply credibly without the need for trust. That is how people actually adopt Bitcoin. That requires proof of work itself. Fed printing money might key in for people, I need to listen to these people that are talking about Bitcoin, but you can only adopt Bitcoin as a function of knowledge distribution. That requires work. So at the same time, when CPI is 8 to 10% and the Fed's tightening financial conditions, doesn't necessarily mean people understand Bitcoin better. They do as a function of time, but those things can be completely detached from each other over a year, 2 years. But what happens certainly is two things on either side of those equations. they will print trillions more dollars, and more people will read books. More people will listen to podcasts. More people will learn about Bitcoin. Bitcoin's knowledge distribution accelerates over time. It does happen in waves, and as it does, more people adopt. And if it's a fixed resource, then they have to force the price higher in order to accumulate it.